earlier this week, I talked about pricing and how there's 3 layers to it. You've got your base layer that has loan level pricing adjusters. Then you've got what the company wants to make. And then you've got what the lender wants to make on top of that. So you've got this 3-layer cake that sometimes, you know, the frosting, which is what we call those extra rates, can be very thick and expensive. So what we're going to talk about today is some of the loan level pricing adjusters that as a buyer, you wouldn't think, oh, wait, if I buy this house, this type of house, it's more expensive with my rate. So Julie is the queen of this. Dive in.
So when an investor is looking at you and looking at loaning you money and giving you interest rates, typically their rates are taking into account the risk you're bringing as a client and the risk that your property type is bringing to them.
So the property type is a loan level pricing adjuster, meaning that the type of property that you're looking at may have additions to the rate or subtractions to that base rate based on risk.
Right, and so a single family home, that's the least risky of all property types. It's the most stable, solid, conservative. You're the only owner of it. It's like...
That's also why you'll see greater appreciation with a single family home versus other property types, is because as a buyer, as an owner, you have the most control over the long-term cost of the house as well as over the maintenance.
And you own the land around your home, however your plot is designed or your land is attributed to the house, you own that. So not only the structure, but also the land underneath it.
99% of the states.
Yes, 99% of the states. Next property type, and this is where we get into the loan level adjustments, is a condominium. And a lot of our buyers are surprised by this.
They're like, wait, why is the rate higher on a condo? My credit's still perfect. You know, my income's still great. Why is my rate higher?
And your rate is higher because a condo is a riskier investment.
Correct.
For an investor. Essentially, it's not just you they're basically giving a loan to in some senses. They're giving a loan to every single person in that building along with you, because if somebody does something crazy in that complex, because again, you guys are all taking sort of like an ownership share in a building plan. Somebody does something crazy, that's going to affect your unit. That could affect your resale. If your association, if people don't pay their HOA dues, that's going to affect your building's ability to maintain the property, to take care of that new roof or the new siding, whatever comes up.
If the HOA is not being properly run. So as lenders, that's something we're constantly looking for is, you know, sometimes people are like, oh, the HOA is so cheap. It's like $20 a month. And I'm like if roofs go bad or something, the homeowners association won't have enough money to pay for it. It's that responsibility. And as the owner of that unit, what can happen is they can, I'm trying to think of the word, but they can basically, I've seen it, this happened to a client of ours, horrible. We were not the lenders on this, but she was telling me about it. I think you know who I'm talking about too. She got a letter. Hey, we need to redo the foundation on the property. There's structural issues. We're going to have to levy a $60,000 hit to your unit to help pay for this. So everyone in the building got these $60,000 bills because the HOA had not been properly preparing for a problem like this. And people go, well, they can't do that. Yes, they can.
Yeah, they can. And they do. And it affects not only, and so when you think about that, you're assessed $60,000. Now that affects the affordability of that unit, right?
Well, right. And so some people don't have the $60,000. Some people can't finance the $60,000. The property starts to go into foreclosure. Well, guess what? You now own a condo where maybe 30% of the units are in foreclosure. So 30% of the fees are not being paid. Your values are going to go down. Lenders aren't going to lend on it. It is a disaster.
It's a vicious cycle. And so investors, again, when they're thinking about risk and they're assessing risk on property types and loans, they take those sort of things into consideration. And that's why your condominium rate is higher.
Yes.
Yeah. And so next category would be a townhome.
I will let you lead with the townhome.
Yeah, so like we have our single family, we have our condominium. Single family, you own the land underneath your home. You own some of the land surrounding your home in most cases, 99% of the states. And then with a condominium, you own your unit. You actually don't own any land underneath. You're in sort of like a share ownership in that building. Townhomes are a little bit different because you're sharing walls in most cases. Many of the townhomes, you actually own the land underneath your unit. And a lot of times, the HOA dues can be less in a townhome development than what we see in condominiums. Townhomes don't really have a loan level price adjuster. I seem to see the rates kind of coming in par with single family homes.
Yeah, I mean, where we really see the big difference is going to be that single family versus the condo. We're usually super relieved if someone's like, oh, I'm buying a condo. We're like, oh, okay, that's great. And then we find on the prelim it's a townhome and we're like popping champagne bottles because we know we get to tell the client that they get a better rate.
Right.
So, and in terms of how dramatic this is, we're not talking about 1% or 0.5%, but we could be talking about 0.25%,
Right.
1/8%.
Right. Oftentimes we're talking about 0.25%. Yeah. And also all of the factors are going to come together in your file to inform that rate as well. Your credit score, your debt to income, and then your property type.
And then we have the fourth one, which somehow I feel like you will not want to wade into. Okay, let's talk about manufactureds.
Queen of the menu.
Yes. That is my title. Okay, so manufactureds are more expensive in terms of rates, for sure. So the big thing is there's a couple things to know. Like, first of all, if it's in a park, a traditional lender's not going to be financing that. So you're going to be looking at the lenders that do manufactureds in parks, and they can be very expensive. They can be 6+%. This is filmed in April of 2021. If it's not in a park, if it owns its own land, okay, and it's a double wide, right? Because we're looking for double wides, you're still going to see a loan level pricing adjuster in every category. So for instance, if I'm talking to a borrower and they're looking at manufactured versus single family, I'm usually preparing them for 0.5% difference. And it can vary. Sometimes it's only 1/4, but I've seen it be a full 0.5%. So I want people to be prepared for that. So it's important to know that if you get pre-approved and you're looking at single family and you switch to a manufactured or you switch to a condo, you need to call us. And I talked about this a couple weeks ago as well, because we need to adjust your pre-approval.
Absolutely.
But the big driver on this video was we're constantly asked, why are condos more expensive in terms of rate? And it's because if it's just you, we trust you.
We've reviewed you. We've seen your file. We know your history. We know your spending habits. We know your ability to repay on your loans. We know your employment history.
We trust you.
We want to give you the money.
We just don't know. There's other factors, right? There's the HOA. There's your neighbor. What if your neighbor's favorite thing, you guys are sharing a wall? What if they like to hit the wall with a weight when they get excited about working out? What if they're burning incense 24 hours so when you walk into your room, you choke on the air?
What if your neighbor above you leaves their water on while they leave for the weekend and all of a sudden
that happens. Or the overflowing toilet. There's been so many overflowing toilet stories. So, in cases like that, you will see a little bit of a price hit because there is a bigger risk to the person who ultimately owns the loan, because if the HOA messes up, if they put you in a position by raising HOA dues where you can't afford it, that house will become a foreclosure.
Yeah, which makes you vulnerable.
Yeah, so we're not against condos.
We actually love them. We work with condominiums all the time. We work with lots of different condo projects. A lot of our buyers are in condos. We love them. We just do our due diligence on the front end to make sure that HOA is healthy and it's going to be able to provide you the sort of support you're going to need down the road in your building and in your unit. And then we talked about the pricing adjustment.
Yeah, and I mean, we are a little different. There are some lenders that will lend on condos that are true disasters that will bankrupt you, but we're very conservative in that regard.
100%.
Yeah.
100%.
So I hope this has been helpful.
Yeah.